Afternoon and welcome to this afternoon's webinar. Sorry that we had a brief technical issue, so we're starting a couple minutes late. We apologize, but we are all ready to go. So today's session is Building a Tax-Deferred Legacy, Estate Planning with Multifamily Investments. This webinar is sponsored by Hamilton Zands. I'm David Bodemer with the wealthmanagement.com editorial team, and I'm your host. In a moment, I'm going to be turning things over to our panel. But first, I'm going to just go through the housekeeping of how you can get the most out of this event. To improve your viewing and listening experience, you can move your webcast windows around by dragging on their title bars or resize them by clicking on their lower right corners. In addition, at the bottom of your screen, you'll find multiple application widgets. Clicking on these icons allows you to open and close widgets on your screen. It will not remove you from the event. Also note, this webinar has been accepted for one CE credit hour towards the AEP designation program. Investments and Wealth Institute has also accepted this program for 1 hour of CE credit towards the CIMA, CPWA, CIMC, and RMA certifications. And the CFP board CE credit has been applied for and is pending approval. Instructions for credit submittal are available in the resource list widget on your console. We also welcome questions about our topic and answer as many as possible following the presentation. Feel free to submit your questions to the queue at any time. Just type it into the Q&A window on the left-hand side of your screen and hit the submit button. Also know that this webinar is being recorded and will be available for on-demand viewing following the event today. With the housekeeping out of the way, I'm just going to do a brief round of introductions and then hand things over. We have with us Ashley Kabeel, Chief Financial Officer, Hamilton Zands, Ed Hanley, Managing Director with CBiz, and Susan Von Herman, a partner with Perkins Coie LLP. With that, I'm going to hand the floor over to you, Ashley.
Thanks, David. Hi, everyone. Welcome to our webinar that will focus on estate planning and multifamily real estate investments. We will discuss some of the overall tax benefits that are available with real estate investments, and we will also dive into estate planning and why it is important. The timing of this webinar is called for because of the current environment that we are in. Recently, the New York Times reported the greatest wealth transfer is here. The great wealth transfer is expected to make the millennial generation the richest generation in American history. The aging baby boomer generation currently holds half of the nation's $140 trillion in wealth. Of that, the real estate represents approximately 13.5% of that total, roughly $18.9 trillion. Of the 73 million baby boomers, the oldest are nearing 80 and are now beginning to die in large numbers. 84 trillion is projected to be passed down from the older Americans to millennial and Gen X heirs through 2045, and 16 trillion will be transferred just within the next decade. The impact of this transfer cannot be understated, and the smart investors are starting to plan. The Trump tax cuts of 2017 temporarily doubled the base amount individuals could give away without paying estate taxes. In 2023, that amount is $12.92 million per individual and $25.84 million per married couple. These exemptions will revert to their previous base levels in 2026, pushing many Americans to move fast. In 2021, $182.6 billion was passed down via lifetime gifting, more than double the $75.2 billion in 2020. Many boomers who are currently focused on their estate plans are giving while living to take advantage of these advantageous exemptions. So how does this apply to real estate? I would argue that multifamily real estate should be a part of everyone's total estate. Real estate investing offers many tax advantages that investors should be aware of. Ed, you have been working in the world of real estate for many years. Can you please discuss the overall tax benefits of real estate investments?
Sure. So what I thought we'd talk about is, as Ashley said, there's about $19 trillion worth of real estate that's going to change hands over the next however many years. And real estate has always been a very large part of the U.S. economy. And as they say, land, they ain't making it anymore. So it will always be an important part of the economy. Since 1913, when we started the Internal Revenue Code, real estate has been one of the most favored industries under the tax law. And there are two principal ways in which real estate are favored over other asset classes. One is an annual benefit and one is a much more long-term benefit. So the annual benefit, the first one we'll talk about, is that real estate, unlike most other investments, provides a tax-sheltered cash flow. So when one invests, let's say, $1 million in a stock portfolio or bond portfolio, that yields 4%. That person gets $40,000 a year of cash flow, dividends and interest from that portfolio, and that is generally fully taxable. Different rates apply, but it's fully taxable as you receive the cash. With real estate, that same $1 million investment into real estate that has a same 4% cash yield, in other words, it's generating $40,000 worth of cash flow to the investor. Well, that $1 million that goes into real estate can be depreciated. And depreciation allows that $1 million to be written off and to reduce one's taxable income while getting the cash flow from the investment. So on $1 million real estate investment, it would not be unusual to get as much as $30,000 or $40,000 a year of depreciation deductions. And if you're getting $40,000 of positive cash flow and $40,000 of operating income, and you have $40,000 of depreciation deductions that offset that, you would actually have zero taxable income being reported. And the $40,000 that you're getting as a 4% yield on $1 million would be after tax a full $40,000, as opposed to if you were getting a 4% yield on a bond, you would only net somewhere in the $30,000 range. So that is the principal annual benefit of real estate over other forms of investment, is that tax sheltered cash flow. And one aspect of depreciation, just to share, because we will be talking about parts of the tax law that are expiring. Currently, because of the uncertainty, shall we say, of COVID, Congress enacted something called bonus depreciation. And bonus depreciation was a way that real estate investors and investors in other types of hard assets can write off their investment much more quickly and shelter their cash flow to a greater degree. The idea when Congress adopted this was to increase the after-tax cash flow going to investors who were buying hard assets to keep the economy moving. That bonus depreciation is starting to wane. It's down to, in 2023, it's down to 80%, and it'll be going to zero after the 2027, I believe. So bonus depreciation is something that expires with some of the other tax benefits that we're going to talk about later in the seminar. I think Ashley has put together an example of relative investments. Ashley, if you wanted to look at that.
Yeah, so before you jump into your next item, I just want to talk a little bit more about the tax sheltered cash flow that you just discussed. I'd also like to add that I believe multifamily real estate offers higher after-tax returns for longer than the shorter-term investments. So today, investors are searching for high yield in historically conservative instruments and finding options that were unavailable until recently. Current rates for short-term positions, including T-bills, CDs, and high-yield savings accounts, are higher than they've been in years. However, by taking a closer look at the numbers, a strong case can be made that multifamily real estate is a smarter choice given its after-tax benefits. So looking solely at rates, an investor may ask, why should they accept the risk and illiquidity of private real estate investment for pre-tax returns lower than investment options? That makes sense if you're simply comparing a 4.5% yield on a 12-month T-bill to a 3.5% distribution rate for a real estate partnership. A quick tax analysis, though, shows this conclusion misses the bigger picture. The effect of income taxes on total returns is significant. To illustrate, let's look at a simple example. An investor making $200,000 annually has a federal income tax rate of 18%, along with a state tax rate of, let's use 6%. A $100,000 CD investment paying 4.5% will net only 3.4% or less after taxes. The tax hit will be more severe for those in higher income tax brackets. By contrast, the distributions for multifamily investments are more tax efficient, given the benefits of depreciation and treatment of income as return of capital. Additionally, the 1031 exchange allows investors to defer capital gains tax when a property is sold, supporting the continued creation of long-term tax efficient wealth. Ed, can you elaborate a little bit more on a 1031 exchange?
Sure. So, before I said there were two different types of tax advantage to real estate. One was an annual, which is the tax sheltered cash flow. But then there's a long-term advantage that real estate has over other investment classes or investment types. So, and that is like-kind exchange or 1031 exchange or deferred exchange. Currently, under the tax law, the only industry that can use an exchange to defer tax is real estate. There used to be more industries that were allowed, but right now it's down to just real estate as of 2017. So what happens with real estate and why real estate is advantaged by this 1031 treatment, maybe a simple example. Let's say someone buys a stock that they think is undervalued and they spend $500,000 on that stock. And someone buys $500,000 worth of real estate that they think is undervalued. And they're right. Both of those assets appreciate double in value over the next few years. If the investor decides to get rid of their stock portfolio, and when it's doubled in value at $1 million, they will have paid $500,000 for their investments. They'll get $1 million for it, and they will have to pay tax currently on that $500,000 of appreciation that they've gotten, losing, let's say, $100,000 to tax. So, they are able to then only invest $900,000 into a replacement investment. Using 1031, a real estate investor whose asset goes from $500,000 to $1 million can get rid of that asset and trade into something else in the real estate industry and not have to pay tax on the appreciation that they've gotten. So, if someone decides that they've made a lot of money in tech stocks, sorry about that, and they decide they want to get into industrial stocks, they have to pay the tax to get out of one industry to get into another. With real estate, however, if one wants to go from owning a warehouse to owning an apartment building, one can go from one to the other and keep deferring the tax using 1031 exchanges. An important aspect of 1031 to remember too, that I think a lot of people forget, is that when one owns a type of real estate or real estate in one area, you can exchange into another type of real estate. In the IRS regulations, the example they give is you can exchange a ranch for a gas station. And that's still a qualified exchange within real estate. So it gives people a great way to keep their money invested within the real estate allocation of their portfolio, but change its geography, change its type, change its leverage, and not have to pay tax. Ashley, I think the example.
Yeah, so I think I'm going to go through, thanks, Ed, a quick example. So in a typical sale of real estate, if a 1031 exchange is not completed, approximately 1/3 of the gains goes towards paying taxes. With a 1031 exchange, those taxes are deferred and all the sale proceeds are reinvested into the next real estate deal. So quick example, let's assume we have two investors, Avery and Leslie, each of whom have $1 million to invest in private real estate. Each invest their $1 million and earn a 4% annual distribution on their investment. After 5 years, each investment is sold for a gain, a 1.35 residual multiple on the initial invested equity. So each have $1,350,000 now in gross proceeds to invest. At the time of sale, let's assume that Avery uses a 1031 exchange and Leslie pays taxes and then reinvests the remaining sale proceeds into the next real estate deal. Immediately in that next investment, Avery will earn $54,000 in distributions, while Leslie will earn $50,780. So there's an immediate difference in the earnings between Avery and Leslie due solely to the fact that Avery completed an exchange while Leslie did not. They continue this process over the next 20 years, transacting approximately 4 times with the same metric. So a 1.35 multiple at every sale and a 4% distribution. So despite obtaining identical residual returns of a 1.35 and same distribution percentages, deferring capital gains taxes allows Avery to obtain superior returns to Leslie. In terms of total return, Avery has received approximately $865,310 more in total returns compared to Leslie. So this includes both deferred taxes and additional distributions over their whole period.
And I'd point out here, if you see on the slide, in that fourth bullet point down, there's $540,000 of deferred taxes. So Leslie was paying tax every time they sold an asset every 4 or 5 years. But Avery was rolling that gain over. And so Avery had deferred $540,000. Then the amazing part about the estate planning that we're about to get into is if Avery or Avery's spouse, if they're in a community property estate, died, that $540,000 of deferred tax would permanently be saved. It would never be due, because when one dies, you get a step up in basis, and there is no tax, no income tax consequence once someone dies and they get their step up. So it makes it a permanent difference, not a timing difference. Sorry.
No, that's okay. It's a perfect transition. So let's pivot to estate planning. So Susan, you've worked on many estate plans over your career. Can you discuss some of the key considerations for investors when creating an estate plan?
Sure. I'll start with the old joke is that if you don't create your own estate plan, the state that you live in has one for you, and you're probably not going to like it. These are called the intestacy laws that kick in when folks don't take the time to put a plan together. Assuming you put a plan together, you get to customize these default rules. A couple of important areas, obviously, where assets go when you die and on what terms. Another really important thing is to specify who will be making decisions for you and for your loved ones when you can't make them any longer. So that's healthcare agents as well as trustees, guardians for children. Once a plan is in place, it's really important to revisit it often. We say to our clients every few years in order to make sure that it still will accomplish your goals. The reasons for this is the elements that go into planning are constantly changing. Tax laws change, the makeup of a family can change, babies are born, folks pass away, family members get married, there's divorce. A family's net worth can go up and down, asset mix can change. And finally, a family's goals can change over time. All of these things affect the estate plan. So it's definitely not a one and done exercise. Another thing to keep an eye on is the estate tax exemption. The current exemption for gift and estate tax is $13 million per person. Assets above that are taxed at 40%. Very important point is this exemption is scheduled to be reduced by 50% in 2026, so just a few years from now. For folks with taxable estates, there are a number of techniques we use to reduce or even eliminate this tax. Many of them work especially well with real estate, which is good news.
So thanks for the overview. What are some of the main tips that you would want investors to know as they start on this journey of estate planning?
Well, the first thing is that basic planning, when I say basic planning, that's typically revocable trust planning, wills, powers of attorney. This planning is completely revocable and changeable. So it's never too early to do it. And as circumstances change, the plan can be adjusted. And as morbid as this sounds, I encourage my clients to really focus on the here and now. Pretend this is going to happen sooner rather than later. Think about who you want in charge if you can't make decisions. Who's going to raise your kids now may be different from 10 years from now, but it's important to focus on now, and also the distribution. It can always be updated, it can always be changed, and it's really, really hard to plan for every contingency. I think it's more important to focus on who's making decisions if you can't. A second thing is, as I mentioned a minute ago, the current gift and estate and also the generation skipping transfer tax exemption are all scheduled to drop by 50% in 2025. So probably right around 7 million. And the way this works is the gift and estate are combined. The GST is on top of that. So many of our clients with taxable estates are looking for ways to use this higher exemption before they lose it. One thing I want to point out is that if you wait till the end of 2025, you're going to have a very hard time finding a lawyer or an appraiser to help you. We're already seeing a big uptick in our business, and I think it's just going to get busier and busier. This may sound like an obvious point, but the earlier that lifetime gifting is done, the better, since more appreciation is moved out of the estate tax-free and not subject to the 40% tax when the client passes away. That being said, it's really important to pay attention to cash flow. It's a little like what they tell you about oxygen max on the plane. I tell my clients to be really conservative about giving assets away. The first analysis is always cash flow, making sure that the clients are going to be safe and secure for the duration of their lives, no matter how long they live. I don't want anybody upset with me later because they've been too aggressive in the gifting department. One big issue with lifetime gifting is that transferred assets take their income tax basis with them. When a person dies, as I mentioned a minute ago, and Ashley, that basis is stepped up. And so to fair market value, which is a really big benefit. And that's obviously not happening if you've transferred assets out of your taxable estate. Fortunately, there's one way around this problem. If assets are transferred to a grantor trust, we'll get into a little more detail on that later. But the main point here is that it's really important to pay attention to basis, especially with real estate, which is being depreciated most likely. And then finally, estate planning, in my opinion, is most often the most successful when it's a family affair. We tell our clients with adult children that as soon as those children have assets, they should certainly be doing their own planning. This can really help with organizing essence, especially inherited assets later on, keeping them separate. Sometimes it can obviate the need for a premarital agreement. Even kids as young as going to college often will execute powers of attorney and healthcare directives since they're out of the house. And it's also, in my experience, if clients are doing lifetime gifting, it's often much more successful if the family is brought into the process. That gives an opportunity for the senior generation to share their goals, thoughts about using wealth going forward. A big concern is that the wealth isn't abused. It doesn't replace the need to be productive. And that's something that can be talked about if it's a family project.
So I have a question for both of you. Over your respective careers, what are some of the benefits that you have seen with passing down multifamily investments through a sponsor? I guess I should define a sponsor as a company like Hamilton Zants, who is an owner and operator of real estate investments.
Well, I can start with that. Yeah, I'll start. So in addition to doing planning in our practice, we work with families when someone passes away. And that's a whole process, a whole project. If you've been through it, you know it's not an easy process. One of the nice things about clients who are holding LLC units through a sponsor is that the transfer process is very, very simple. It's a title change basically on the account. Another thing that's nice for the family is all of the relationships can stay in place. This is a little bit like what happens if you have an investment manager managing your stocks and bonds. If there's a change in terms of the family constellation, the investment manager continues to manage the assets, oftentimes for the younger generation, and there's real continuity. This is the same thing with sponsored real estate. There's continuity, and the company can bridge the gap between the generations, which is really terrific. And then the last thing is accounts can be easily split. Compare that to if kids inherit an office building or a shopping mall and two want in, stay in, and one wants out. It's really tough to deal with that situation. If they're inheriting, on the other hand, sponsored investments, those can easily be split into different accounts, and the beneficiaries can make different choices.
I think what I see is, a benefit of multifamily through a sponsor is that the older generation who have put together generally an allocation of their assets or built an entrepreneurial portfolio of real estate. It might be, the warehouse where the company that the family owned used to operate, or, it's an apartment building that the grandparents left to the parents, or some sort of entrepreneurial real estate where the family has managed it or the family has owned that concentrated position that requires management and requires time and effort and a desire or even an ability to manage a concentrated position in real estate that's entrepreneurially owned. When an older generation has that, they often look around. My clients, they look around and go, my children are not interested in running real estate. Or, I had one client, she owned a set of flats in San Francisco, and the set of flats were subject to rent control. And she had two kids who were running their own businesses and their own careers and had children. And she's like, They don't want to be managing 6 tenants and managing refinancing and managing when a tenant moves out and managing repairs at 2 a.m. when the plumbing backs up. And so what she did was she went and exchanged out of that entrepreneurial piece of real estate, which had provided that family with a very nice living for many years. And instead, she went to a sponsor. She went with Hamilton Zands, and took the equity in that entrepreneurial piece of real estate and diversified it into 3 different apartment complexes in 3 different states around the country, where she used to have to deal with a bookkeeper and deal with collecting rent and deal with paying bills, or even if she outsourced to a management company, she'd still be doing that. Instead, once or twice a year, she meets with the sponsor, and quarterly, she gets checks from the properties that she owns. And when her kids inherit that property from her at her death, it will have a stepped up basis. They can easily split it. As Susan said, those partnership interests can become easily split between the kids, and they can go their separate ways. They're not tied at the hip after the parents die.
So I think I'm just going to tag on to that for some additional benefits with investing with a sponsor. I think it's really important for families to consider investing in real estate with a sponsor. If a family decides to stay invested in their family office building, planning will need to be done with respect to management going forward. And in some families, as Ed had alluded to, there's nobody at all that's interested or suited to step into that role. So that can make the co-ownership of a building really difficult with family members. Families should look to potentially sell that building and use the 1031 exchanges with a company like HZ prior to death. This sets up the estate to have the best possible outcome for their real estate investments. Multifamily investing through a sponsor takes investors out of the day-to-day management tasks while preserving all the benefits of real estate investing that Ed had previously discussed. By investing with a company, investors get access to their knowledge, the Rolodexes, the institutional grade professionals, and real estate. So for a company like Hamilton Zands, we plan to be around for a long time, and we hope to have that generational family investing with us to make sure multifamily real estate is part of our investors' profile. So another question for the both of you: what are some of the tax considerations when passing down income producing properties that investors should consider? Ed, I think I'll start with you on this one.
Well, I think it comes back to the things we've talked about before. The basis step up. When we were talking about the tax sheltered cash flow, and when there's a basis step up. So say the first generation had bought real estate for $1 million and they depreciated it down to $200,000. And when they die, it's worth $4 million. Well, that basis step up that they get at death resets the amount of basis that they can depreciate. And so after the death of the older generation, that basis step up will provide even more depreciation deductions and more of a tax shelter to the cash flow that is coming from the real estate. And then Susan?
Sure. As I mentioned earlier, one way to have your cake and eat it too with lifetime gifting is to make gifts to grantor trusts instead of making gifts outright to individuals. A grantor trust is a trust that is outside the client's estate for estate tax purposes. So the gift we're using the exemption, we're getting the asset outside of the estate. As the asset grows, that growth will not be subject to the 40% tax when the client dies. But we include certain terms in the trust that make the trust the same taxpayer as the client for income tax purposes. So for income tax purposes, it's the same, and the client has to keep paying the taxes. Again, cash flow, and we need to make sure it works before this is put into place. But that means that transactions between the client and the trust don't have income tax consequences. And the payment of the income tax is actually a free gift. So in addition to the $13 million, the client can be paying the taxes on the income that's generated inside the trust without any sort of gifting happening, because it's his or her own liability in the eyes of the IRS. And grantor trusts, one of the ways we make them grantor is by including what we call a swap power. This gives the grantor the ability to from time to time, pull assets out of the trust, put other assets in the trust that are of equivalent value. And this can be very, very, and again, with no tax consequence because they're the same taxpayer. So obviously assets in the trust are not getting a basis step up. So one thing we want to think about as clients get older is to look at their portfolios and see, do they have low basis assets in trusts that are not going to be stepped up, high basis assets in their own named, where the basis step up is not going to be so significant. That's a really good time to utilize the swap power. So a simple example would be if a client has transferred, say, $3 million of assets. At the time the assets were transferred, it was $3 million to a grantor trust, but via gift, and then depreciated those assets inside the trust, and the basis is now $1 million, but the value is $4 million. Something we could do is pull those depreciated real estate assets out of the trust and replace them with cash or possibly marketable securities that were recently purchased or where there hasn't been a lot of growth, assets with high basis. And then when the client passes away, the assets in the trust don't need a step up because they have high basis. They go to the beneficiaries. The assets outside of the trust in the client's estate are stepped up and they go to the beneficiaries with high basis. So it's a win-win. And then the beneficiaries can turn around and redepreciate the real estate investments.
So continuing with the focus on estate planning, Susan, what are some common estate planning mistakes that you see with real estate investments?
I think probably the biggest one is when clients get to the point where they own real estate, and now I'm not talking about sponsored real estate, I'm talking about that shopping mall again, and it's getting to be too much to manage. They look down the road and they think nobody wants to manage this, or our kids are not going to be able to for some reason, and they decide to get rid of it. If they do that, most likely there's going to be a major capital gain hit at that point. So it's so much better to exchange it, as everybody's been talking about. One of the things to keep in mind is, and this is a point that Ed made earlier, you can swap a shopping center for a gas station. You can also take your home and turn it into investment property by renting it for over 2 years. And now your home is investment property. It can be swapped. This isn't just for investment real estate. Another thing to know is that sponsored real estate is a valid 1031 exchange holding. So in the example I just gave, you can sell the shopping mall, and then instead of recognizing the gain, roll the proceeds into a sponsored investment, hold on to that, the client passes away, and then there's step up. Another common mistake I see is thinking that once a plan is in place, it doesn't need to be adjusted. Estate planning done right is a dynamic process. It's really important to have a good relationship with your estate planner because it's not a transactional business, in my opinion. Definitely not a one and done. Things are changing all the time in most people's lives. And for that reason, it's important to be looking at the planning. Another mistake I see is folks who think that trusts only make sense where there's a lack of trust. Once their children get to be old enough to be responsible, they think they don't need to be inheriting in trust. That's leaving a lot on the table. Most of the trusts I set up for the next generation, the children, once they're old enough, are in charge of those trusts. There's no third-party trustee, no big brother, no control from the outside. But these trusts provide very important asset protection, including divorce protection, and also tax protection. And then finally, the last thing I'd say in this category is it's very dangerous to be doing real estate investment outside of your home territory. We see investors who are maybe investing in California, they decide to buy a property in Tennessee without realizing that the tax laws are completely different. Going back the other direction, California has some property tax rules that are very, very complicated, even to those of us who spend a lot of time in California. One of the nice things about sponsored investments is that all of that work is done for you. Whoever set up the investment has learned all those rules, hired the right people in the appropriate jurisdiction. So another benefit of this kind of investing is that you can diversify across the country without having to spend the money to learn all the rules on your own.
So I think just to come in behind that, so here at Hamilton Zants, we've been working with our investors for a long time as they're going through this estate planning and generational transfer. I think the main mistake that I see is not transferring knowledge onto the next generation. So I agree with Susan. I think families should be discussing estate plans. I know they're not always the easiest conversations. They're extremely personal. They could get to be difficult decisions, but they're so important so that everyone is aware of the plan and the assets that are involved. I think getting heirs involved early so that there are no surprises is probably one of the best plans of action. Some of the things that we've seen work best for families who we've worked with is introducing the next generation to different sponsors that you're working with, the investment advisors that each family is working with. Families should be surrounding themselves with great estate attorney and tax advisor who can help navigate the ever-changing landscape of gifting and estate planning. It's also really important to plan and revisit, like Susan had mentioned, because of life changes. And I think also one of the best steps is that instead of owning your own real estate, invest with a sponsor, have your kids learn to invest with sponsors, whether that be through a Delaware statutory trust or a tenancy in common or real estate partnership shares that are invested in a deal. Any of those things all have the same tax benefits of owning real estate. And if the next generation is seeing those benefits firsthand, I think that's the best thing that a family can do to continue to own real estate in their estate. So final question for both of you. How should investors prepare for the future estate and tax law changes that are coming about or may come about?
We've mentioned this a few times. The big thing that's happening in 2026, January 1st, 2026, is the gift and estate tax exemptions, as well as the generation skipping transfer tax exemption, are going to be reduced by 50%. Generation skipping transfer tax exemption is important because if it's allocated to trusts, like the grantor trust I mentioned earlier, those trust assets can stay outside of not just the next generation's taxable estate, but generations into the future. So it's a very powerful exemption and shouldn't be wasted. If you have a taxable estate, it's important to consider whether you should be implementing a gifting plan. And then I think get it done as early as possible. Again, I think that it's not just that everyone's going to be really busy. We've seen prices go up. For example, the price of appraisal can go up when the appraiser has way more work than the appraiser can do. Another thing to think about is if you're married and using the full exemption is too much, it's much better for one spouse to use his or her entire exemption than for each spouse to use 50%. Because then when the drop happens, one spouse has used the entire thing and the other spouse will still have the lower exemption level.
So what about you, Ed?
I think the principal income tax difference that's coming is that the depreciation rules are going to get less favorable over the next few years. And every time that has happened, it has led to a land rush for people to buy or sell assets, depending on which side of the transaction they want to be on, before the law changes. So I think everyone in real estate and everyone in estate planning is going to be busy between now and this law change that's coming in 2026. And what really is important is to start planning now. I remember in 2012, if people remember, there was an estate tax issue, and I can't remember exactly what it was, but I think the exemption was going to a very small number or something. And the number of people who put off dealing with that until the last 2 months was just amazing. And I had clients who would call and say, Ed, can you help us? Because our lawyer just said, sorry, there's 15 people that I can't get to already. And we were like, sorry, we don't practice law. So it's super important that you get to people like Susan before the last minute. And a lot of the things that can be planned, you don't have to necessarily pull the trigger, but you should get educated, you should get ready, and you should have a plan in place for when you do want to pull that trigger. At least you'll understand it and you won't have to start from scratch.
So thank you both, Ed and Susan, for all that information. If I could tie a bow around all of that and leave our audience with one thing to remember, there's a lot of country club talk about estates and real estate and family planning, and a lot of it is wrong. There's a lot of flexibility around real estate and estate planning. Please surround yourself with good advisors. Talk to the people who know what they're talking about to ensure that you put your family in the best position possible. So I think now we will be opening it up for questions. If anyone is interested in additional information, Hamilton Zants has numerous educational resources for investors looking to build generational wealth. We have a new webpage, white paper, and educational videos all located on our website. So please visit and please reach out if you have any questions. But I think we will open it up for Q&A right now.
Great. Thank you all for that great presentation and discussion. We got a ton of questions that came in, so we're probably not going to be able to get to all of them, but all of the speakers will be shared a report with the questions, so anything that we don't get to, they'll have an opportunity to follow up maybe directly if it's more appropriate. But we're going to try to get through as many of these as we can in the time that we have left. So we have a couple of questions that are just trying to, I guess, clarify on sponsored real estate. Is a unit trust like a DST? I think there was a number of questions around I guess some of the specifics around what's a DST, or what are some of these structures that you're talking about?
Sure. So I guess when we were discussing sponsored real estate, that's working with a group like Hamilton Zants for a Delaware statutory trust. So a Delaware statutory trust is a vehicle that investors can exchange in and out of. So it will accommodate a 1031 exchange. That piece of real estate is purchased by the sponsor, and then those beneficial interests are opened up to other investors. Hamilton Zants stays in the game to asset manage the real estate, and then we'll hire a third-party property manager to manage the real estate for us for the day-to-day stuff.
Another question here is managing with a sponsor the same as hiring a company to manage the asset?
So it's a little bit different. So in terms of a sponsor, that would be like Hamilton Zants, who is putting the real estate deal together, deciding what debt to put on, packaging the investor side of things. The day-to-day third-party management, it can be done multiple ways. What works best for our properties and investors are the ways that it should go. HZ is vertically integrated with a property management firm called Mission Park Residential. They handle all of the day-to-day property management stuff for our entire portfolio. However, different sponsors do it different ways, whether it be vertical integration. They may do property management in-house themselves, or hire a third-party property manager outright to manage their buildings.
Another question that we have here is, how long are your holdings typically?
Hamilton Zants is typically a long-term hold. Our average hold for our portfolio that we've sold is just over 5.5 years. Even though we have a 5.5-year hold period, we're continuing to do those exchanges, in perpetuity, because 1031 exchange is a pretty powerful tool.
So Ashley, for an example, could you, an investor who went into your assets in 2005, even though you have a 5.5-year hold, that person could still be exchanging and
Yes.
moving forward their tax.
Yes,
So it's
correct.
a 5.5-year hold, but you can be there forever. Well,
Correct. So that's a 5.5 year for the actual underlying asset, but we have partnerships that have been together for 20 plus years that have continued to exchange, and then maybe at this point have owned 5 or 6 assets during that time frame.
Another question is, how does this all impact an estate where the corpus is intended to go to charity? Can Hamilton Zants shift ownership of a property to the charity? Does it then need to hold until it is sold?
So I can take a stab at this, but I'll let Susan jump in too. I think if there is a charity or a charity involved in an estate plan, yes, we can accommodate that. We've done that a handful of times, where whether it be the DST beneficial interest shares or partnership shares in the LLC, or even a TIC interest, have then ended up with a charity. It can be done. I would say the only thing that's difficult for us, it's more difficult when there is a tenancy in common position where they own a true deeded interest in real estate, because most likely that charity will want to liquidate. And, real estate is typically illiquid during the whole period, but we have seen that. We have accommodated that. If it's within a real estate partnership, that's a little bit easier. The shares would just transfer to that charity's name, and they can decide what they would like to do with those shares.
And it's probably also going to depend on the charity. Technically, a private foundation is a charity. So if family and investors leaving interest in private foundation, that's going to be treated differently than a public charity.
Right.
Can you explain the process of involving a principal residence in a 1031 exchange?
I think Susan mentioned it, but Susan, you want me? I'll jump in.
Go ahead.
So in order to do a 1031, the property that is being disposed of has to have been held by that taxpayer for use in a trade or business or for investment. And a principal residence is not held for investment or for use in a trade or business. So as Susan said in her presentation, what you can do is, someone who has a principal residence that is very substantially appreciated can move out of the residence and then rent it out for 2+ years. After 2 years, virtually everyone is comfortable that principal residence now can now safely be considered to be held for investment or for use in a trade or business for rental. Once it has seasoned in that way, the principal residence becomes investment property, then the investment property can be exchanged. And that's how you accomplish that with a substantially appreciated personal residence.
And depending on, I had a client just choose not to do that against my advice because he has a very, very valuable home and he's older. Hire a management company. You don't have to be, as Ed said, going over at 2 a.m. when there's a problem, but a management company can rent it out. There's no problem using a third party to do this. And then again, after 2+ years, get out of it safely.
Another question here is, are there still concerns that the 1031 exchange rules may be modified or eliminated? I know this is something the real estate industry has been fighting to maintain.
Ashley?
You can go first. I was going to say, you can go first, Ed.
1031 has been on the block since I did not have gray hair. And it happens to be one thing that everyone seems to like to talk about. But California is the capital of the 1031, and California has 10% of the House of Representatives and some very powerful people. And the real estate industry has a lot of powerful people. And I think they all circulate those rumors just so they can raise more money for their reelection campaigns. 1031, absolutely there's an old saying, no man is safe in his life or property while the Congress of the United States is in session. So anything is possible. However, 1031s have survived since, I think, at least the 1930s, if not the 1920s. And I think they'll survive for a good long period to come. Ashley, you guys probably talk with lobbyists more than I do.
Yeah, I would agree with Ed. I think it comes up as a topic of conversation every time there's a change in Washington. I agree with that. I personally do not think it is going anywhere. 1031 exchange, I think it gets attacked a lot because people believe that it's just helping the big corporations who own and manage real estate continue to do 1031 exchanges. But when you look at the actual numbers, it's a lot more our smaller investors who are owning real estate and taking advantage of the 1031 exchange. And so, it's going to be talked about again, most likely in this next upcoming election. But most of the lobbyists that we've had conversations with believe that it'll stick around for the long run.
Yeah, I feel like I've been writing about this industry long enough that I write about that every few years as well.
Yeah,
it just comes and goes.
Dust off the last paper because I'm sure it'll apply.
Some more questions here. We're going to try to get through a few more. We had an hour allotted for the webinar where we started a couple minutes late, so we'll probably go just a little bit past the hour. But here's another question that we have from, I'm still not clear what is a sponsorship. Is it a way to sell one's assets to investors and have the sponsor reinvest the proceeds in other investments?
No, that's not a sponsored investment. So what a sponsored investment means is coming to Hamilton and Zants. We look at assets across the country. We will pick a real estate deal, and let's say the purchase price is $100 million. We will put that property under contract. We will figure out how we're going to pay for it, whether it's a combination of debt and equity, and at what points. Is it 50% leverage? Is it 60% leverage? And then the rest equity. We'll come up with a business plan for that asset in terms of CapEx, how we're going to run it, where's the upside, what do the returns look like over the whole period. And then we will close on that transaction. All while that's happening, we will be meeting with investors to understand their 1031 exchange needs if they want to invest cash into this deal. And then we will put together what that equity stack looks like. So when an investor comes to us, this is the deal that we're looking at. Would you like to invest in this real estate? So it's not, taking the funds and not moving it around like that. It is a true real estate to real estate. There are other options as well in terms of partnerships that would be invested in multiple assets. We do also have a fund where you're investing into a fund and that fund will go buy multiple assets. But in terms of talking about 1031 exchanges and how we facilitate a 1031 exchange sponsored deal, it's going to be a Delaware statutory trust where investors can exchange into a specific real estate deal.
I think, David, the way I look at it, kind of because my clients go to sponsors, is it's a way for an investor to outsource the buy, sell, hold, operate, and leverage decisions with respect to real estate. They can find someone to take on all those roles that they're currently doing when they own their own real estate, and they outsource those decisions on buy, sell, hold, finance, operate.
Another macro question here. How are interest rates impacting sponsored real estate investment opportunities? Same question as to insurance and availability rates.
Yeah, so interest rates are going up, and that is affecting our deals in terms, I would say more so it is the uncertainty in the market that's affecting the deals more. But yes, our interest rates are higher on the deals that we're purchasing now. There is price discovery happening right now between buyers and sellers and what these assets are trading at, and debt comes into play there. I would also, to insurance costs are going up as well. And so all of those things need to be factored into our underwriting of a sponsored deal to understand where the returns are for our investors. And so returns have gotten thinner for our investors, but even though that cash on cash return has gone down, kind of all of the other benefits of real estate are still there in terms of bonus appreciation, capital preservation. So where this timing in the market right now has a direct impact on what the immediate yield is on the asset, kind of those longer term benefits of real estate are still there and should be considered as well. But I would just say in general, there's a lot of price discovery and understanding where each asset can perform.
Another question for you. How liquid are interests received from a sponsor like Hamilton Sands?
So real estate is an illiquid investment for the most part, right? It's investing money and earning a return and riding the wave for an ultimate residual. I would say historically in our 1031 exchange and TIC structure, DSTs, the liquidity event typically happens when we sell the underlying investment. You can get liquid during the hold period. We just have to go through a process of trying to sell those shares, but I would say pretty illiquid during the hold period.
And then I think another follow-up on the principal residence question. So if I have a residence, rents out for 2 years, and then 1031 exchange into shares in Hamilton Sands, can I make gifts of that to kids or grandkids?
I'm sorry, can you leave it to kids and grandkids?
I guess, can you make gifts of, I guess after
I think
you've
it's
done
gifts.
this, after you've
How
done
soon
this,
after an exchange, Susan, can you make a gift? Do you have to wait a long time or do you not have to wait? I guess it's how I'm reading the question.
No, there's no, no, the basis goes right with it. So there's no, the IRS doesn't care about timing there at all. What the IRS cares about is not selling your principal residence and not paying the gain. It needs to become not your principal residence before you do that. And then once you've done that, I mean, the gift could happen during the time that it's an investment property. It could happen at any point.
All right. Well, I think we're past the hour, so I think we probably are at time. And we went through a lot of questions here, so I appreciate that. So I guess give you a chance if you any final words before we do a final wrap up here.
I guess I would just say thank you for everyone joining, and any questions that we didn't get to, we're happy to address those, and please reach out to any one of us for additional questions.
Great.
All right. Well, I just want to thank Ashley, Ed, and Susan for that great, once again, thank you for that great discussion and for taking so many of those questions. I'd also like to thank Hamilton Zan for making today's program possible. For the audience, once you leave the event, a short survey is going to pop up in your browser. We would appreciate it if you could share your feedback, as it does help us to provide you with the most relevant content going forward. So on behalf of wealthmanagement.com, thank you so much for being our audience, and have a productive rest of the day.